Signed and Funded, Episode 5 Pre Approval. What it is, what it isn't, and how to get one. Let's get into it. Quick question for you, and be honest. When someone says they're pre approved to buy a home, do you actually know what that means? Or does it kind of blur together with pre qualified and you just assume they're basically the same thing, kind of the same thing, maybe totally, definitely the same thing, or you just really have no idea whatsoever? If you're not sure, you're not alone. Most buyers aren't sure, and most of the time, it doesn't matter until it does. Until you're in a multiple offer situation, your agent is trying to submit an offer, and the listing agent calls to see if you're really pre approved or if you're just pre qualified. And suddenly, that little difference is everything. I'm Scott Alfano. This is Signed and Funded. And today we're going to draw a very clear line between these two terms, walk through what the pre approval process actually looks like, and make sure you know exactly how to get one and what to watch out for when you do. Let's get into it. Firstly, before we get into everything, I want to thank you all. I know that I have not recorded an episode in the last 2 weeks. I actually took my family down to the Oregon coast. We were in Seal Rock, enjoyed a ton of time with my girls, my wife, going to the beaches, going to the aquarium, taking hikes. I initially wanted to record episodes while we were down there. I brought my microphone, I brought everything I needed. But once I got there, I decided, this is family time. I want to keep it family time. Let's take 2 weeks off and regroup. And that's exactly what we did. So we're back into it. It was a great relaxation. And now I'm here ready to go again. Welcome to episode 5 of Signed and Funded. We're officially in the first time buyer cluster. Over the next several episodes, we're going to deep dive on everything a first time buyer needs to know, from financing and down payments to making a winning offer and closing the deal. Today's episode is foundational. Pre-approval is step 1 of the entire home buying process. It's what you do before you start looking at homes seriously, and it's one of the most misunderstood steps in the whole transaction. Part of that confusion comes from the fact that the mortgage industry itself hasn't been great at standardizing these terms. Different lenders use them differently. Some lenders will hand out pre-qualification letters like candy and call them pre-approvals. Others run a full underwrite before they'll even send you a letter. That consistency creates a lot of noise. So let's cut through it. Start with the basics. Pre-qualification. What is it? Pre-qualification is an estimate. You tell a lender what you make, what you owe, what you have in the bank, and they run a quick calculation and say, based on what you're telling us, you probably qualify for around X. Sometimes they pull your credit. Most of the time they don't. It's fast, it's easy, and it's not worth very much in a competitive market. Here's the problem with pre-qualification. It's based entirely on unverified information. The lender hasn't seen your W-2s. They haven't confirmed your employment. They haven't reviewed your bank statements. They've taken your word for each piece of the puzzle that makes up what you could be approved for. And in a real estate transaction, your word doesn't move houses. Pre-approval is very different. A real pre-approval means the lender has actually done the work. They've pulled your credit, and by that I mean a hard pull, not a soft check. They've reviewed your income documentation, your W-2s, your tax returns, your pay stubs. They've looked at your bank statements to verify your assets and your down payment. And in many cases, a real pre-approval means a human underwriter has actually reviewed your file and signed off on it conditionally, pending the property details. As you can tell, a pre-approval is a completely different thing. This is a lender saying we've looked at this person's financial picture, we've verified it, and we are willing to put our name on a letter saying that they are good for this amount. Sellers and listing agents know the difference. When you submit an offer with a pre-approval, especially one with underwriter involvement, it's treated with a different level of seriousness than a pre-qual letter that took 5 minutes to generate online. So when you're shopping for a home in Seattle or anywhere in a competitive market, pre-approval is the standard. Pre-qualification is a starting point, not the finish line. One more important point before we move on. There's a term that you're going to hear called conditional approval or credit approval. This is essentially a step beyond standard pre-approval. It means the underwriter has reviewed your file and issued a conditional approval. The loan is approved pending conditions like a satisfactory appraisal, title work, and the final property review. If you can walk into a home search without a conditional approval, that is a serious competitive advantage. It tells a seller that your financing is essentially done. All that's left is the house itself. Okay, so you know what pre-approval is. What does actually getting one look like? Step one, you're going to apply with a lender. This can be a bank, a credit union, a mortgage broker, or a direct lender. You'll fill out what's called a 1003, the Uniform Residential Loan Application. The Uniform Residential Loan Application, or URLA, covers your personal information, employment history, income, assets, debts, and the property that you're looking to buy. If you're early in the process and don't have a specific property yet, that is completely fine. You can complete the application for a general pre-approval amount. Step 2, document collection. This is where most people feel the friction a little bit because the lender is going to ask for a lot. Here's a standard list of what you should expect to provide. 2 years of W-2s, or if you're self-employed, 2 years of federal tax returns, a month of recent pay stubs, 2 to 3 months of bank statements, checkings, savings, investment accounts, your most recent retirement account statements if you're counting those as assets, a copy of your driver's license or government issued ID, and if you have rental income, divorce decrees, or other income sources, document all of those as well. Pull all this together before we even start talking to lenders. It makes the whole process faster, they all ask for the exact same information, and it signals to the lender that you're serious. Step 3, the credit pull. The lender is going to pull your credit. This is a hard inquiry, meaning it will show up on your credit report. A single hard inquiry typically drops your score by a couple of points temporarily, nothing dramatic. But here's something important. If you are shopping multiple lenders, which I do strongly encourage, try to do all of your credit pulls within a 45-day window. Credit scoring models are designed to recognize rate shopping behavior and will count multiple mortgage inquiries within that window as a single inquiry. So you can shop around without tanking your score. You just need to be strategic about timing. And even as a lender, of course, I would love for any of my buying clients to work with me on the lending side as well. But I encourage everybody, before we pull your credit for the very first time, let's come up with a full list of every possible bank, credit union, etc., that you are possibly interested in hearing a quote from. Once we have them all set up, we start that clock. We'll get the first credit pull done, and then generally within a week, I like to have my clients have all of those pulls done. Whether I usually recommend at least half a dozen different sources. Sometimes I've done up to a dozen, sometimes even more, especially in areas that have many, many different credit unions. I used to live on the East Coast, and that was very common in Florida. So there were a lot of options to choose from. As long as they are all done together, as I was just talking about, it is going to be considered one hard credit pull, and it is one drop of a couple of points. If you're not sure if you're ready to be buying a house and you go out, you do a few credit pulls, and then 90 days later, you do it again to see if anything has changed, or maybe you think you're a little bit more serious at that time, that's going to be a separate credit hit. So I've seen people sometimes over the course of a year, they'll get 4 or 5 hard hits, all just because they're looking for a mortgage, and they don't wait to do these pulls when they know that they're finally serious about buying the house. They do it sporadically and don't realize the impact of what they are doing to their own score. Step 4, the lender reviews and issues the letter. Once they processed your application and documents, they'll issue a pre-approval letter stating the loan amount you've been approved for, the loan type, whether it's conventional, FHA, VA, whatever it is, and sometimes the interest rate, though rates can change between a pre-approval and closing. How long does this take? A basic pre-approval from a responsive lender can come back in 24 to 48 hours as long as you have your documents ready. A fully underwritten approval can take a week to 10 days, so plan accordingly, especially if you're thinking about starting to look at homes in the near future. One thing to know, pre-approvals do expire. Most of them are valid for about 60 to 90 days. After that, the lender is going to need to re-pull your credit and re-verify your income before they'll reissue, just as I was talking about a couple of minutes ago. If you've been house hunting for a while and your pre-approval is getting close to expiration, Get ahead of that and don't let it lapse in the middle of a transaction. Pre-approval is not a guarantee of a final loan approval. I want to say that part clearly because a lot of buyers get a pre-approval letter and think that the hard part's done. It's not yet. Pre-approval is conditional. The lender has reviewed your financial picture as it stands today. But between pre-approval and a closing, a lot can happen, and some of those things can kill a deal. Here is what to avoid between pre-approval and closing. Most common, do not make any large purchases. No new cars, no furniture, no appliances on credit. New debt changes your debt to income ratio, the same ratio your lender used to qualify you. A new car payment can flip a qualifying DTI to a non-qualifying one overnight. Do not open or close any credit accounts. Opening new accounts creates other hard inquiries and can lower your score. Closing accounts can reduce your available credit and also lower your score. Leave your credit profile exactly how it is. Do not change jobs. Lenders are big on employment stability. If you switch jobs, even for more money, it can complicate your life, especially if you're moving from salary to commission-based income or vice versa. If a job change is unavoidable, tell your lender immediately. Do not make large deposits into your bank accounts without documentation. Lenders will scrutinize your bank statements during the loan process. A large, unexplained deposit can raise red flags and require a paper trail. If someone is gifting you money for your down payment, that needs to be documented with a gift letter. Plan this ahead of time. Gifts for down payments are pretty common. There's nothing wrong with doing that. Just make sure that it is documented. Suddenly receiving 20 or 50 or 80 or $200,000 into your bank account out of nowhere is going to raise a ton of red flags. So tell your lender ahead of time if you plan on receiving a gift for your down payment. And then once that happens, have it documented and it will be smooth sailing from there. Do not go quiet on your lender. The loan process involves a lot of back and forth. You'll get requests for additional documents. Respond quickly. A delayed response from the buyer is one of the most common reasons for closings to get pushed back. I've had a lot of conversations with buyers and they say, how quickly can I get approved? How quickly can we close on this house? And the most realistic answer is I can get this loan ready to close in 3 to 4 weeks if no one or nothing gets in my way. And without saying it, most of the time it's the buyer themselves that get in the way of a loan closing quickly. So again, don't go quiet. If there are any documents requested, get them in as quickly as you can. It is generally the buyer that is the bottleneck in the loan process. So help yourself out and do as much as you can as quickly as you can. Here's one other thing that I want to address. The pre-approval number is not your budget. We've covered affordability back in episode 3. The lender is going to give you the maximum that they will lend you based on your financial profile. That number doesn't account for your lifestyle. It doesn't account for your other goals, your savings rate, or how you actually want to live. Use the pre-approval as your ceiling and build your personal budget from there. As both your agent and your loan officer, this is one of the conversations I have early with every buyer I work with. The number on the letter is what the bank will do. The number that you should shop is often lower, and knowing that difference up front makes every decision in the process cleaner. Here's your action item from today's episode. If you're thinking about buying a home in the next 6 months, start your pre-approval now. Not when you find a house that you love, now. Get your documents together. Talk to at least 2 lenders. Again, I recommend at least half a dozen so that you get a lot of ideas and a lot of conversations with a lot of different people who know what they're doing. Ideally, do this within a short window so it counts as one credit inquiry. Understand what you actually qualify for, what the terms look like, and what your real monthly payment would be at a few different price points. And if you want to talk with somebody who can handle both sides, your agent and your loan officer in one, that's exactly what I do for buyers here in the Seattle market. You can find my link in the show notes. Reach out and let's talk through your situation. If today's episode helped clarify something that's been fuzzy, share it with somebody who's going through this process. First-time buyers especially need this information before they're sitting across from a listing agent, not afterwards. Subscribe so you don't miss next week, because we're staying in the first-time buyer lane and tackling something else that trips people up constantly. We'll be tackling the 20% down myth and how it is really not that necessary, it's not that common, and it keeps a lot of people on the sidelines who could be buying homes right now and don't even realize it. Next week on Signed and Funded will be down payments demystified. You do not need 20% to buy a home, and that 20% myth is keeping a lot of qualified buyers on the sidelines for no reason. We're going to break down what your actual options are, what low down payment programs exist in Washington state, and what the real trade offs look like between putting down more versus putting down less. I'm Scott Alfano. This has been Signed and Funded. Now go make a good move.